I'm going to show you a trading strategy that you can implement using about 5 minutes of your time to put on, and then you only need to log into your account maybe once every day or 2 days just to check on it. And it's really geared towards busy professionals, busy people, people that want to have a minimalistic style of trading with not too much stress. Okay, and it's very consistent as well. So I'm going to show you step by step what to do. So you want to open up a futures watch list with options available to trade. If your broker doesn't display this watch list natively, copy these ticker symbols, make your own custom watch list. Make sure you've got IV rank on your watch list and order the list from high to low IV rank. Okay, we are not interested in trading any underlyings that have an IV rank of under 30. So we've got quite a good selection to choose from here because everything is over 30. If you do have a smaller account, you maybe want to stick to things like wheat, lean hogs, US treasuries, bonds, currencies, soybeans, etc., things like that. In today's video, we are going to take a look at the Japanese yen. It has an IV rank of 67. And what we're going to do is once you've selected your underlying, go over to the trade tab, and what you want to do is pick an option expiration date that has between 30 and 60 days left on the contract. So June 6th here has 51 days left on the contract, so we're going to open that up. And this is just a position that I've mocked up already, and I'm going to walk you through what we did. So what you want to do is have a small directional assumption. You don't have to have a directional assumption, but if you are going to take just one side of the trade, i.e. you're going to sell calls as opposed to puts or both, then just have a small slight directional assumption. It doesn't really make a difference. If we have a look at the chart for the Japanese yen, we don't trade based off of the chart, but as you can see, it has been doing pretty well recently. It's been going up. So let's just take the small directional assumption that price will either stay where it is, maybe go up a little bit, not too much, or possibly go down. So a very small, short directional bias. Okay, so what we're going to do is we are going to sell a call contract. Okay, the reason why we are going to sell this call contract is because before we do that, what are we doing? So if we were to buy this call contract, what that means is we need price to move higher than the strike price of 0.0074. And you have a pop, which is probability of profit of 18%. So you have an 18% chance of this trade coming through for you. If you sell the contract or short the contract, it's now the inverse. We are taking the opposite side of the trade. We have an 82% chance of this working out for us. And in this instance, it means that if price goes lower, we win. If price stays where it is, we win. If price goes higher, but not above 0.0074, we win. Okay. Actually, price can go higher because there's gray area here, which is at break even. So even if price did go a little bit over 0.0074, we'd still make a little bit of money. Okay, just as long as it doesn't go too far higher, sort of in this red area here, that's where we'd lose money. Okay, so in this instance, we have an 82% chance of success, and the reason why we picked this strike is because it's around a 20 delta. Okay, you can be more aggressive and go closer. 20, anywhere between 15 and 20 deltas is a good place to start. You can be really conservative and go out to a 10 delta, a 5 delta. Your win rate is just going to increasingly go up and up and up, but the amount of profit or the amount of premium you collect will reduce as well. So a nice medium point is around a 20 delta, between 15 and 20 deltas, but you can play around with it depending on your risk tolerance. And if we look at the numbers here, we're going to collect $575 or $587 up front, and our broker is going to require just over $2,500 in buying power. So what we're going to do now to reduce this buying power requirement is buy another contract further out. Okay, and we're always going to end up with a net credit. We are always going to collect a premium because the contract that we're buying, that we're paying for, is further away from the at the money price compared to the short contract, which means we're always going to collect more on the short contract than what we're paying for the long contract. So we're going to end up with a net credit, as you can see here. So now that we've done this, our max profit is going to be $150. That's what we're going to collect. upfront, and our buying power requirement is going to be $330. So we've significantly reduced our buying power requirement, and you can see here we have a max loss of 1.1k. Now, this max loss is in the absolute worst case scenario. Every loss is not going to be your max loss. It's rare that you end up with a max loss. So I've had people in the comments trying to calculate profitability, assuming that every loss is the max loss, and that's just not the case, okay? So you're going to collect $162 up front, you're going to use $330 in buying power, you've got a 79-80% chance of success. That's if you hold until expiration. Now, this is a major key here. We are not going to hold till expiration. We are going to exit early, no later than 50% of max profit. So you have a P50 here, which is probability of hitting 50% of max profit at some point during the trade, which is not displayed for futures. For equities, it's displayed, but basically your P50 is going to be about 10 to 15% higher than your POP. So we would be looking at a 90% win rate here, a 90% chance of success. In fact, it's over 90%, okay? So we are getting an over 90% chance of success. We're collecting $162 up front. And when we say we're going to exit at 50% of max profit, that's 50% of this $162 number here. So around $80, you'd want to take profit and close out. Okay, and your buying power requirement is going to be $330. Now, once you've put this trade on, you only really need to check it maybe once a day, once every couple of days. You can simply just set a limit order to close the trade as soon as it hits 50% max profit. In the times where the trade moves against you, you can simply just do nothing. You can exit at around 50% of the time duration, so around 25 days. So there's 50 days left on the contract. At around the 26 day mark, you can just close out if you're in a profit. If you're in a small loss or around break even, you can also close out. If you're in a heavy loss, then you could just wait and hope that the market turns around. But even if it doesn't, it's absolutely fine. It's going to be very rare that happens. Remember, you have an over 90% chance of success here, and your max loss is only going to be realized in a very, very few circumstances. It's very rare. So with that in mind, you do need to keep your buying power in check. And to do that, we've got a free position sizing template. The link for that is in the description. And the way it works is you enter in the size of your portfolio at the top, and then you enter in whatever the current VIX level is below, and everything's going to be dynamically calculated for you based on the current volatility in the market and the size of your portfolio. Okay, it's going to tell you exactly how you need to structure your portfolio. It's going to tell you the maximum amount of buying power to allocate to defined risk positions, undefined risk positions. What we took a look at here in this video is an example of a defined risk position. So if you go to the defined risk section, in this example portfolio, if the VIX was at 32.8, we'd be able to allocate $1,250 per position. In this instance, that covers the buying power requirement and our max loss. So this position would be absolutely fine to place in your portfolio. If you have a larger account, you can just make the spread wider. You will collect more up front. You will have a higher probability of profit, and your max loss and buying power will increase as well. If you have a smaller account, you can make it narrower. You can, adjust and go out a little bit. Reduce your delta. If you want to be more aggressive, you can go in and increase your delta, and basically you can play with the numbers to fit your risk tolerance. But I prefer to just have a very high win rate, and that's about it really, and not have to worry too much once I put the trade on. So as long as you're sticking to this, the bottom line is you'll be fine. If you would like to learn in more detail, click on EDS Premium. The link for that will be in the description. Get yourself signed up. You will have access to this exact portfolio that I showed you an example of. This is a very small portfolio that we are using in EDS Premium, and the reason for that is because even if you have a small account, the idea is that you'll be able to at least follow along on the trades that we're doing. If you have a larger account, you can just drop me a message and I'll show you how you can scale up while still using our trades here. We've closed out a trade already today. We've had 3 trades this week. All 3 trades have come through, so a 100% win rate so far this week. We've just been doing some 0 day to expiration stuff. Really great for account building and things like that. So you get access to the portfolio. There's a full course, so no prior knowledge is required. We'll teach you everything you need to know. It is a private community, so if you get stuck, you can speak with myself directly or with other like-minded individuals that are already inside making money. There's a 100% money-back guarantee as well. So after 6 months, once you've been through the course, follow some of our trades. If you're not profitable at that point, we'll work with you for free until you are, or you can simply request a full refund. So it is completely risk-free. It's $9.99 a month to join right now. The price will be increasing, but once you're in, the price is locked in for you for life. So you are rewarded for getting in early, and the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. We want to give you the skill. Once you've learned it, you could take it with you for the rest of your life, and no one can ever take it from you. Okay, and we aim to get you to a point of where you are self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.